Welcome back to Retirement Coffee Talk with Sharice Rivers at Zinnia Wealth. Online, you can find us at zinniawealth.com, Zinnia wealth.com. Where do you think the odds are better, Las Vegas or the stock market?
Really?
Maybe you own that. I mean, let me tell you something, folks.
No, don't even do it, Randy.
I have never stood next to somebody who is so good at roulette and so lucky in Las Vegas in my life as Sharice Rivers.
I am not good.
Yes,
Listen,
you are.
You're making me look like an awful person that
No,
I
you're
gamble
not.
every once in a while. I was interviewing Jonathan Kane. We were in Vegas, Journey guy. He's been there from the get-go.
He wrote all the big songs, yeah.
Yeah, and so the concert was in Caesar's Palace. We stayed in Caesar's Palace, and I woke up, had my coffee in the morning, and until Randy, I'm like, we were just walking by the roulette table, and I'm like, hey, let's put a couple of bucks on this green double green. And it's not green double green, it's zero double zero.
Right. 0 and 0 0. Yep.
Well, anyways, it came in 4 times, and I just kept piling it up. And then I walked away. I walked away with my money.
That was good.
Then we went in and we did the interview, which was amazing. Right?
Yeah, I've seen you do this on more than one occasion. So you're
okay,
really
you've
good.
seen me do it twice. So I am a lucky ducky. Full disclosure. Okay, move forward. I am
right, here we
lucky.
go.
But here's the deal. This is a risk discussion. Randy.
Very risky. Very risky.
And are you better to invest? You asked the question in Vegas or in the stock market.
All right. So,
well, it depends if you're looking at the long term or the short term game. But whether it's long term or short term, you're always going to lose in Vegas because when you lose, you can't ever make it back unless you pull more money out. In the stock market, if you're doing the long game, if you lose, right? What do we have? We have our magnificent 7 that are down. We have Microsoft down 10%, Google down 20%. I don't know. Amazon's down like 8, Meta's down almost 20, Nvidia's down like 30, right? All these stocks are down, but if you hold them, you don't have to sell them for income and you focus on the 10-year plan, it's going to come back. So yeah, investing in the stock market is a better strategy than investing in Vegas. So I'll answer your first question.
All right. Okay. So I looked at the odds here. We all know that the house always wins, right? We'll win occasionally, but in the end, as Sharice says, the house wins because that's how the game is built. Your chances of winning at table games, blackjack, roulette, and all the different games, or in the slots, are between 3 and 12%. That's your winning edge. So if you've won, congratulations, you really beat the odds, okay? Now, if you invest money in the stock market for 1 year, you have a 66% chance of a positive return. At 5 years, a 76% chance. And at 10 years, an 86% chance
in the stock market
of having a positive return.
Okay.
But the big difference is, as you just pointed out, Sharice, in Vegas, you get paid right away. In the stock market, you got to wait to see your payoff, sometimes all the way into retirement. Not quite as exciting, but sometimes boring is better. I've heard people say in the past, have an exciting retirement, have a boring investment plan.
Right.
So one of the things that people mistake on is I need to beat the market. I need to match the market.
Right.
I need to have a return of an average of 8, 9, 10%.
Yeah, that's
and
great stuff.
that can really work against you, can't it?
It can. I think we kind of repeat ourselves on different shows, Randy, about we don't have to have double-digit returns. We just need to protect from double-digit losses.
There you go. We should put that on a bumper sticker or something, Sharice. We really should.
Because in retirement, you're not in accumulation phase anymore. You guys are thinking, Sharice, you're nuts. No, you are not. You have to do a mind shift, a mind change, because now you're in decumulation. And I know some of you are like, that sounds awful, but it's not awful. Decumulation just means, hey, we've spent 30 to 40 years saving this boatload of money, and now we're going to live on it. That's all it means. So we're still going to accumulate and make money, but now we're in decumulation because we're living on it. So the investment strategy, the psychology of money changes. And nobody's teaching you why it's so important to change your philosophy, because if you do the hang-in approach, like people did in 2000, 2001, 2002, when the stock market went down 33%, those are the ones that are out of money today because they didn't change their spending habits or they have pittance left over and they had to change the way that they lived in their lifestyle. 2006, 7, and 8, it was an 18-month decline. The S&P dropped 50.1%. Those people, when the market went down for 18 months, you had to crawl out of this hole for 4 years. That means you can't touch your money. So is it what you make or what you keep that is most important in retirement? And I'm going to tell you over and over again, it is what you keep. I am telling you, it is what you keep. And I know most of you listening that are retired, you felt the pain and you know what I'm saying. And those people who are just retiring now, you have zero clue because the market hasn't crashed since 2008. So you've been growing. You're like, well, my portfolio went up 400%, right? Okay, yeah, it's been climbing. So now you're at the top of this mountain, and now you got to figure out as you're coming down this mountain, you're living on this money, how to make sure that it lasts for the next 30 to 40 years. And if you do the old school strategy like people did in the 80s and 90s, and you enter the 2000s, that first decade of 2000s, and you didn't change your mindset, you didn't change your plan because you're following outdated strategies and you didn't convert over, yeah, you are going to risk running out of money, right? If inflation continues to rise or we go through all these ebbs and flows, which historically we've always gone through. So when you're investing your money, it's not what you make, it's what you keep. But did somebody dial in and say, here's your income plan? Based on the next 40 years of your life in retirement, you actually only need to make 2% and you're not going to outlive your money. Did they show you, hey, you have to make 4%? We got to find that plan that makes 4% so you don't run out of money in your early 80s or early 70s. Or are you that person that we have to make 7%? And if you are that person that has to make 7% for the next 30 to 40 years of your lives, you should not. You have no business in retiring today because it's not going to happen. Because when the market goes down, what are you going to live on? And when you have to crawl out of this hole, what are you going to live on? So we have to make sense of the psychology of your money and how it's going to work in this decumulation phase. So we just have to educate you. And we love having money in the market. I'd rather you have more money in the market, but I don't want all your money to lose. Right? And most people in retirement, they don't walk in here, Randy, and say, give me the jiggliest thing you got, Charisse. No, they're like, no, I want to make 7% and I don't want to lose and I don't want to pay you fees. So how do we do this? Right. And so we can make dreams come true, but there's a 50-50. We got to plan this out. We got to make a couple of bucks and not everything's going to make 7% in your portfolio. Some stuff is going to make 4, some 5, some 6, some might be 30%, right? So we just have to draw the plan out, show it to you, look at it for the next 40 years with an inflation adjustable income plan on top of that, and then see where we land on a pessimistic viewpoint 40 years out. And is there any money left over for long-term care if you go in the facility? And if that's the first spouse and then the second spouse goes in, do we have enough money left over? And then is there any money left over for the heir? So there's a lot of planning when it comes to a retirement plan.
Sometimes a boring 5% is your best friend.
And it is your best friend.
Yeah. and to know that I could make 5% on my money and I could have a successful retirement. Wouldn't that take some of the pressure off? I got to believe it would. So let's have the conversation. If we find you've got to make 10%, as Charisse says, we got some adjustments. We got some real talking to do. But 2%, 3%, 5%, come on. Maybe that's where you are right now, and the only way to know that is to sit down and talk through it and do some numbers. Give us a call. Give us a look on our website, ZinniaWealth.com, ZINNIA Wealth.com. There's a gold box there. It says Complimentary Retirement Consultation. Click on that. We'll ask you a couple of questions, a little contact information there, and Charisse's team will reach out to you, and we'll sit down and talk through some of those numbers. You can also call us, do the very same thing, 833-368-3680.
Thanks for listening to the Retirement Coffee Talk podcast. If you have questions or would like to begin the process of building a tailored retirement plan, call Zinnia Wealth at 833-368-3680 or find us online at ZinniaWealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Sharice Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and or categories usually do not deduct transaction and or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.